Why does it feel like the next stock market crash is always just around the corner? Perhaps there's nervousness around the stock market right now, driven by the huge run up in prices over the course of the past 12 months. Perhaps it's the fact that we're trading at historically high premiums, especially compared to other years throughout the course of history. Or perhaps it's just the simple fact that every single year the media look to tell us that there is a stock market crash absolutely imminent. We're certainly all programmed to believe that a stock market crash will occur at any given moment, largely because both fear and greed are two of the main driving forces of stock market volatility. But when we strip back the noise and when we think objectively about the purpose and the underlying reason why we're looking to invest in order to secure our financial future, should we be worried about if and when a stock market crash is potentially going to happen, or simply should we just focus on the long term instead? Well, it's something that we should probably talk about in a little bit more detail, but before I do so, guys, my name's Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video, guys. It really helps out the channel. And with that being said, let's dive straight into it. So is a stock market crash actually going to happen? Well, I guess in short, the answer is yes. They have done throughout the course of history, and they certainly will do into the future as well. We have the most famous market crashes like the 1929 Wall Street crash, 1987 Black Monday, the 2000 dot-com bubble bursting, the 2007 financial crisis, and much more recently, the pandemic crash of 2020. Market crashes always occur regardless of how you look at it. And according to a little bit of market analysis done by the Motley Fool, over the course of the past 121 years, there have been 33 bear markets in total, which means the stock market has sold off by 20% or more. So when we take an average of these numbers, you can certainly expect a market crash to occur every 3.6 years. There's simply no avoiding it whatsoever, it's simply just part of the game. But I certainly think one of the main reasons why so many people don't ever get started investing and why they simply sit on the sidelines is because they believe that the point at which they start investing into the market will be the point at which the market then goes on to crash thereafter. As a result, many investors out there are on the continuous path to look for the best time to invest rather than investing their money and then just waiting for a long period of time. And look, the media are certainly partly to blame for that, because let's face it, negative news is good news for the media because they know it will mean more clicks for them and more money in their back pockets. It's simply the reason why you see a lot of YouTubers posting lots of doom and gloom in their titles and thumbnails, because they know they'll get more views as a result. And look, I'm certainly no innocent person in doing that. I've done it myself in order to gain more traction and gain more views on this YouTube channel. It's a bit of a toxic cycle which focuses in on how many views can I get rather than what's potentially in the best interest of the viewer instead. And of course, there's always plenty of opinions flying around in the investing space. Some investors are obviously bullish right now and will continue to be bullish throughout the course of the coming years ahead. However, other investors aren't so bullish and in actual fact are a little bit more bearish on the market. And the reality is that there are plenty of investors with plenty of opinions who will always call out that something terrible could potentially be just around the corner. And to kind of bring this to life, I found this chart over on Google, which I think many of you guys will probably find a little bit interesting. We have many investors on here who come from all different walks of life. Some are authors, some are journalists, and some are renowned investors. And they've given all kinds of different commentary throughout the course of the past decade. First up, we have an individual called Felix Salmon, who's a financial journalist who said in 2010, "Get out of the stock market right now because stocks are a dangerous thing to own." And I, for one, can certainly say that that comment certainly didn't age too well. Next up, we have Robert Wiedemir, I think I've pronounced that correctly, who is an economist and author who said back in 2012, 50% unemployment rates, 90% stock market crash, and 100% inflation as soon as 2012. But it gets better, because fast forward to 2014, Paul Farrell, another intelligent looking author, calls out the crash of 2014 will be like 1929, you'll never see it coming. Even Carl Icahn, who is a multi-billion-dollar investor, calls out that danger is ahead back in 2015. Now, since then, the market is actually up 127%. You can see just by looking at these handful of opinions just how much there will always be a bear market opinion and somebody somewhere out there presenting doom and gloom of what potentially is to come. And the reality is, if you let those few individuals dictate your investing decisions, the chances are you'll never invest a single penny. But on the one hand, there are opinions, and then on the other hand, there are major economic events that have happened throughout the course of history that may also put a little bit of a dampener on your ability and your willingness to invest any money into the stock market too. Just in the past decade alone, we had the flash crash of 2010, we had the European sovereign debt crisis, we had the US federal government credit rating downgraded, we had the almighty Brexit, we've even had a goddamn global pandemic to add to the list where the whole world shut down for 18 months, and despite this, the market is still up 300% in the past decade. One thing that I've certainly learned over the course of the past few years is that regardless of how bad the economic events feel in the moment, the market really doesn't care about anybody's feelings, and over the course of the long term, it's shown that it consistently goes up in value over time. At which point you may be saying to me, well, Mitch, the reality is the S&P 500, as an example, is literally trading somewhere very close to all-time highs right now. Prices have absolutely skyrocketed in recent years, and you can see just by visually looking at the chart just how potentially parabolic the S&P 500 is, and as a result, I'm pretty confident that a market crash must happen at some time very soon. And this certainly is true, but it's also the wrong way to actually read a stock chart. And I most recently figured this out when I was watching a podcast over on Tom Bellieu's channel with a pretty famous investor called Raoul Pal, where he said we should actually look at and focus on logarithmic charts rather than that of regular charts. So let me explain. On a regular S&P 500 chart, this is what you see. What appears to be an extremely overextended chart which looks parabolic and has to come crashing down sometime soon. And that's true, but that's just the way that the chart is designed to look. Let me provide some additional context. If we look at the chart between 1985 and 1995, the S&P 500 grew 100%. And between December 1997 and May 2000, we also saw that same 100% gain. But can you see just how much it looks like the chart has visually gone up? Between November 2016 and today's current market prices, we're also up that same 100%. And the size of this move possibly looks 2 to 3 times that of the same 100% gain that we saw back in the late 90s. But the truth is, the percentage gains are absolutely no different. So by definition, the higher in which the stock market goes over time, every single time the stock market doubles, it will certainly look bigger than the last time in which it occurred. And that's certainly why you see the chart as it is today looking like it's absolutely parabolic, seeing exponential growth. It's literally the power of compounding in action. And this is certainly why it makes us a wise comparison to look at a logarithmic chart instead. Because now when we take a look at this chart, over on the right hand side looking at the axis, you can see it's changed to highlight periods of doubling within the market. And instead of seeing one huge exponentially growing chart, you can now start to see a more naturally inclining upward trending graph, which in actual fact looks like the S&P 500 has grown pretty consistently over the course of the past 70 years. And when I highlight those same 3 instances where the stock market has doubled in the past, you can actually see that one is no different to the other. Now this was certainly a complete eye-opener for me when I'm looking at the chart like the S&P 500, something which looks completely overpriced right now, but it certainly makes you look at the chart in a completely different light. It simply shows that the S&P 500 is a steadily upward trending graph and has been over the course of the long term, and that's the predominant reason why I'm going to continue to invest regardless of what any investing guru or any media outlet has to say. So with that said guys, I hope you found this video useful. If you did so, all I ask is that you do drop a like on it, as well subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.